Today, the U.S. stock market opened a special trading session, a quiet but tense session, as if the entire Wall Street was standing in front of a big door, knowing that once this door opened, everything behind could change in a completely new way. Market psychology, money flow behavior, and investor expectations, all are gathering like a large stream of water in front of a hydroelectric dam. Just a signal from the Fed, the dam will open. But before that moment comes, let's take a deep look at what is happening on each of the major U.S. indexes today. From the beginning of the session, the Dow Jones maintained a steady pace but did not break out. The S&P 500 advanced slightly but lacked strong traction. Meanwhile, the Nasdaq, an important measure of technology stocks, showed clear hesitation. The narrow fluctuation range, the slowing liquidity and the slow increase speed showed a reality. The market did not want to take risks, but also did not want to step back. This is the type of market that the most experienced investors understand. That is, when the big money is observing, taking a step back to see the whole picture before they really make a move. And it is when the money is on the sidelines observing that the market will switch to a state of trading by psychology, where every number, every word from the Fed can change the price direction. The macroeconomy is still the focus today. Inflation is showing signs of cooling down. The unemployment rate is mild, a highly appreciated signal because it shows that the labor market is cooling down as the Fed wants. Meanwhile, American consumption, the main driving force that has kept the economy stable for many consecutive quarters, tends to slow down. This creates two emotional extremes. One side hopes that the Fed will soon change direction. The other side worries that the U.S. economy has started to slow down too quickly. And it is these two extremes that create a strong tug of war in investor behavior today. But what is more important is the movement of each industry group. Technology continues to dominate but is no longer running as strongly as before. The biggest names in the AI, semiconductor and cloud computing industries are all in the green, but the cash flow is no longer as massive as a few weeks ago. Investors understand that technology valuations are at a very high level, and if the Fed does not give a clear signal, buying more at this price level is a big risk. This is the reason why the technology group today is in a stabilized state, not falling but not exploding, like a compressed spring, just waiting for a catalyst strong enough to bounce. While technology has been showing signs of recovery, interest rate sensitive sectors are starting to regain momentum. Banks are showing signs of a slight recovery as the market believes interest rates are nearing a plateau. Industrials are showing signs of growth as expectations of public investment and corporate investment are returning. Real estate, which has struggled during the high interest period, is also showing new vitality as the market begins to consider the possibility of the Fed cutting interest rates in the next quarter. These are small movements but have great significance, because they show that the market is in the first phase of pivoting, where smart money is preparing to shift from stocks that have grown a lot, to stocks that have not grown but have the potential to explode strongly. The most notable point of the day, and also a signal that few people noticed, was the development of ETF capital flows. When ETF money continues to flow into the market instead of withdrawing, it speaks to an undeniable truth. Institutional investors have not abandoned the market. They are just waiting for the right moment, not losing faith. This also explains why, despite the lack of supporting news, the market has not fallen sharply. The reason is because the foundation of the money flow is still strong. But behind that calm lie risks that the market has yet to fully appreciate. High-tech valuations mean that even a weak report could send prices tumbling. Energy prices are moving in lockstep with geopolitical events, and even a sudden turn could put renewed pressure on inflation. U.S. consumer spending is falling, credit card debt is at record highs, and interest rates and debt are rising slightly, all signs the Fed is sure to consider at its next meetings. That's why the Fed remains cautious. Not because it doesn't want to cut rates, but because it understands that the U.S. economy is treading a fine line. Cutting rates too quickly could spark a return of inflation, but holding rates too long could choke off consumption and growth. In that context, today's trading session accurately reflects the overall market sentiment: patience, waiting, and calculation. This is a period when investors should not act on instinct, but on data. Choose stocks more carefully, observe the movement of money, and especially follow every word of the Fed next week. Because just one signal, no matter how small, can open a new uptrend or pull the market into a necessary correction. Today's market did not increase sharply, nor decrease sharply, but anchored prices, kept the rhythm and maintained strength. And it is sessions like that that are the foundation for big increases. Because in the stock market, what is important is not the rate of increase in a day, but the direction of an entire cycle. And today, the market is preparing for that new direction. A dovish Fed could see a big bounce. A cautious Fed could see a few more sessions of sideways trading. But either way, this is a time when the most patient investors will be rewarded.